Sal Capizzi is the Executive Vice President with Dunham Funds. We use them also for the not-for-profit community. They have a wonderful platform for nonprofits as well. They also have, I've got a bunch of clients that have been having money just sitting around at 0.000 nothing %. So Dunham actually has a wonderful cash management platform as well, and we're seeing for clients typically 4 to 4.5%, and that was before the quarter-point rate increase that the Fed just announced yesterday. So that will increase our rewards for those cash management programs as well. So Sal Capizzi, come on up. Sal is the Executive Vice President for Dunham Mutual Funds. And by the way, Sal, congratulations on Dunham Trust being the #1 trust company in America. That is wonderful.
Thank you. So good morning, everyone. What I want to do is I want to talk about accountability. But before I do that, I just want to make sure that you understand the relationship between Dunham and RJ. As you know, RJ has built a financial services company that has various pieces to it. There's the consulting side of it. There's also an investment side of it. So what we do at Dunham is we work with people like RJ, who are financial advisors on the investment side of his business. So we work specifically through financial advisors, but we have a difference, a big difference that I don't believe that you'll find in many other asset management companies, and that lies in accountability. Now, when you think about accountability, I want you to think about it from this standpoint. There was a pitcher for the Detroit Tigers. His name was Armando Galarraga. Does anybody know his story? How many perfect games have been pitched in Major League Baseball? So it's about 140 years that they've been keeping score. They've been recording all of the accomplishments that go on with various ball players during the year, right? 140 years of baseball times 154 games that now are 162 games, right? All these teams, only 23 perfect games have been pitched in baseball. Armando Galarraga retired the first 26 batters to face him. He had one batter to go. If he retires that batter, he would have pitched a perfect game. The batter hits a ground ball to the infield. The infielder fields the ball, throws it to first base, hits the first baseman's mitt right before the runner steps on first base. Jim Joyce was the first base umpire. Guess what he did? He extends his arms out this way and calls the runner safe. Armando Galarraga did not get his perfect game. But when Jim Joyce goes back into the locker room, he looks at a video of the play, and it's clear he blew the call. It was clear that the first baseman had that ball first before the runner touches the bag. So what did Jim Joyce do? He immediately went to Galarraga and told him, "I blew the call. That runner was out, and I cost you a perfect game." To me, that's accountability, because none of us are perfect, are we? Right? We're all trying to make calls throughout our life, throughout our professional careers, in terms of what you all do on a day in, day out basis, but it doesn't always work perfectly, does it? Right? So when you talk about accountability, what accountability simply means is then what do you do? How do you hold yourself accountable? So when RJ on the investment side, when RJ is managing assets for his clients, the way RJ chooses to be held accountable on the investment side is that when his clients aren't making money, he does not collect an advisory fee. That is something that very few financial advisors or Merrill Lynch brokers or anyone in the industry that I'm aware of do. So that's his level of accountability. What he's saying is, my call, right, has to be right. If I call him safe and he was really out, I have to be accountable for that, right? And again, we're not perfect. The markets move in odd ways. We were talking this morning about how odd this market is. So if I told you yesterday morning, if I told you that the Fed was gonna meet yesterday, and if I told you here's what's gonna happen, they're gonna raise interest rates by 25 basis points, and what they're gonna say is the reason we're doing it is because basically the economy's sound. It's a good economy, we're on good footing, so we feel comfortable raising interest rates, and in fact, we're going to be doing it again as the year goes on. What would you think would happen, right? Well, one thing you'd say, well, interest rates are going to go higher, so the bond market's going to get hurt because rates will be going higher, because most investors will believe rates will be much higher going forward, and you'd say, and the stock market should do well, because they're saying, the reason we're raising rates is because the stock market is doing well. So RJ could be making a call saying, you know, things are going to be great. Guess what happens? Now, I don't know if anything's changed, but the bond market's rallying. In other words, interest rates are actually going lower, significantly lower. In fact, the lowest one-day move that they've made in 6 months, right? And the stock market was down about 250 points before we started this meeting. So sometimes you don't know. So you're sitting there making the safe call when in fact the batter's out, right? RJ works that in a manner where he says, listen, if you don't make money in your account, I'm going to be losing a lot of weight, because on the investment portion, I'm simply not going to be taking the advisory fee. What Dunham does is we work with RJ in terms of the investment process. So what we do is we have a series of funds where what we do, they're Dunham funds, and what we do is we hire what's called a sub-advisor, right? So if you think of a firm like Fidelity, Fidelity hires Fidelity employees to manage the assets. We take a different approach that says we want to find who we believe are the best institutional managers for that asset class. So if we're looking at international bonds, our analysts go out and say, okay, who do we believe are the best international bond managers that are out there, right? And then we hire that person to run that particular fund. The difference, however, is in the way those managers get paid, right? So with RJ, I'm talking about RJ's advisory fee. Within the funds, there's a manager, the person buying the securities, buying the stocks, buying the bonds, that gets paid, right? That person gets paid at Dunham based on their ability to outperform their benchmark. Again, accountability, right? Because that manager's making calls all day long, aren't they, right? Sometimes they're right, and sometimes it's just the wrong call. But what's the accountability that they face if, in fact, their performance falls below a benchmark? Now, what's a benchmark? If I'm a stock manager, the S&P 500 is a benchmark, right? So if the concept is, yeah, and there's a company called Standard & Poor's, right? And they take a look at 500 stocks. And every day they add up the value of those 500 stocks, and they take a look at that value and they say, is that value more or is it less than yesterday? So when you hear that the S&P 500 was up 9 points today, it simply means that when they added up all those 500 stocks, it equated to 9 points higher than the day before. If they say the S&P was down 9 points today, it simply means that when they added up all those stocks, that sum was 9 points less than the day before. The concept is this: if you're a professional stock manager, you would assume just for a moment that when you look at these 500 stocks, you'd say, okay, there are 200 of those stocks, these companies, that I really don't like. I don't like the business model, I don't like the business they're in, I don't like the sector they're in, so we're not going to invest in those. There are probably about 100 stocks that you like, that you think are good companies that you may be invested in. There's probably 200 that you're looking at. Not sure yet, do I want to add them to the portfolio, not add them to the portfolio, but based on your knowledge, you should be doing better than the 500 stocks in general, shouldn't you? Right? In the industry, most managers get paid regardless of whether or not they outperform that benchmark. At Dunham, what we do is we have a fee program where they get paid based on their ability to outperform that benchmark. If they do, they can get paid more. If they don't, then they can give up a substantial portion of their fees, some down to zero, right? So it creates yet another level of accountability. So when you think about the structure that RJ has developed for his business, what he's saying is, okay, I want the managers that are actually managing those assets, I want those people to be held accountable to doing what they're doing, and then myself as a financial advisor, I want to be held accountable to being able to do well. And if I don't make money for my clients, if that system that, when I used Dunham, if that system didn't work, if I made the safe call when really the runner was out, then I don't make an advisory fee on the investment portion. Does that all make sense? Now one of the things that RJ mentioned was, you know, there are a number of businesses that have long-term cash, not the cash that you use day in and day out to, you know, pay payroll, to take care of day in and day out expenses, but longer-term cash that may be sitting within the business. What do you do with that, right? If you're sitting, if you have the money in a money market account, there was an article in the Wall Street Journal 2 weeks ago talking about how the average money market account right now is paying somewhere around 0.15%, right? Well, when you think about that, what that means is for every $1,000 you have in that money market account, you are going to be you're going to be receiving $15 in interest. Let me say that differently. Let's assume just for a moment you want to buy pizza for all your employees. So you call up Papa John's and you say, I'd like to get a pie out to my company where I'm buying lunch for everyone. And what I want to do is I want to use the interest I earn on my money market account to pay for that. Do you realize at $15.99 for a Papa John's pizza, you won't be able to buy that pizza with that interest? So how do you make those assets work a little bit better for you? So in one of our programs, we call it our core fixed program, where you can have your money diversified in a number of different investments, because typically the way you make more money than a money market account, you have to take a lot more risk. You can take credit risk, or you can take interest rate risk. What's interest rate risk? When interest rates go higher, then your bond value is worth less. It's an odd thing about bonds, right? And sometimes it sounds counterintuitive, but when rates are higher, and it's simply for this reason. If I have a bond that's paying 3%, and if now rates have gone up to 5%, if I have $100,000 in my bond at 3%, I'm receiving $3,000 worth of income, correct? If rates go up and now they're 5%, how much income is that? Well, that's $5,000. What would you prefer? Would you rather have $5,000 of income, or would you rather have $3,000 worth of income? Well, clearly you'd rather have the 5. So as interest rates go higher, that bond that I'm holding at 3% is going to be worth less and less, right? It's what they call, when they say a bond's trading at a discount. So within this portfolio, what we call our core fixed portfolio, 64% of the portfolio has very little correlation to interest rates. Correlation simply means how does it react when interest rates go higher or lower. So we use other non-traditional type of fixed income vehicles in order to satisfy that, right? So it's just something that if it's something that you're thinking about, you should definitely speak to RJ about.